So it's more of the same with the distillate market driving everything in oil. We dive into the complexities around why we didn't see this coming, why the fundamental picture actually makes sense, the ramifications of sentiment and all that. The winners and losers, as usual. We've got some more niche discussions around refineries, as always, the officials guys. And just a quick reminder, I have mentioned this before, but very soon we will be switching this show into a more research-focused show that will go on flux.live. So you have to go to the website to then receive that, watch that show. And then from there, we will be moving to full-time on the platform. Again, it's $400 a month. We think that's fairly priced, benchmarked against the subscriptions out there and the value it creates, all the data, all the bid offers, everything is included for $400 a month. So please get that because we will be winding things down on YouTube. So hope you enjoy and at least see you here for the next couple of weeks. Thanks. Mita.
So the market is definitely cooling right now. So we see prices consolidate. There's a very strict resistance at the $70 handle and we see this consolidation, this cooling down in volatility and risk as well. So just beginning with options and options open interest. If you look at my chart over here, we still see for September Brent futures, we still see options open interest concentrated at the $95 call and $65 puts. The $95 call specifically has been of interest for quite some time now. The $95 call was bought in such volumes in May and June, and it still remains the most concentrated in terms of risk. With expiry next week, it'll be interesting to see if this leads to just any volatility in price action. And for now, open interest changes week on week have been fairly uninteresting. We have seen some interest in around $70 calls, $75 calls, but that could just be speculative interest at this point because this is also for the end of last week, so it could just be mid-month speculative interest. So here you can see that increase week on week and all of them. So if you see $95 calls have actually come off a bit, so but they still remain the most concentrated of all of them. But what I find interesting is in terms of just how expensive these options are. So just for our audience, I'm going to look at implied volatility, which is different from historic volatility in that it is more forward-looking. So it is deciphered from how options are traded in the market. And so it's the market's gauge of volatility. It looks at how expensive these options are. And this particular chart from Bloomberg looks at, so you've got out-of-the-money options on the far left, out-of-the-money puts on the far left, going forward to out-of-the-money calls on the other end. So you can see that week-on-week decline from that white line to that green line and out-of-the-money call. That just shows that players have been de-risking. There has been less interest in protecting one from upside risk versus put options have been fairly stable, which I find really interesting. That this shows that the market is sort of consolidating, and now you see event risk being largely a thing of the past. This is
and all the open interest is there in the options. It's kind of fake open interest, I guess, in the sense that it's been all hedged out or about to expire, and it's not really an options-driven market anymore, essentially.
No. So we did see a small rise in options in call interest in just last Monday. This was the 14th. This was when the Russian sanctions were announced. But same with the futures market. That was basically sold into no one seemed to care about it further into the week. Same thing happened in options. We saw...
Well, that's on options, but I think the market was turning more quite bullish. And actually it was pretty surprising the week I wasn't here that Brent did go back below 70. I mean, that's not...
I was going to say, because we were kind of talking, like this time last week, we were talking, it was, talking quite bullish news, and like the narrative was quite bullish, and then end of the week sort of, just kind of turned, and then all of a sudden...
Because of the Russian news?
Well, yeah, I think that was like sort of catalyst, wasn't it?
But I think with the Russian news, it was also about, so the EU was putting on sanctions, and Donald Trump did talk about the 50-day and everything, but at the end of it, volatility was sold into. And I think there was just so much dissonance between what the US is going to do, what the EU is going to do. And it's the practicality of determining Russian origin crude and, whether India...
But I think people largely shrug that off. You're talking about
Yeah.
the general market sentiment of being bullish, and the
Yeah.
market is obviously super strong. Go back to the underlying being super strong. It was on a bull run, right?
Yeah, it felt like it.
And then
Yeah.
just got sold into like pretty massively.
Yes.
Yeah.
Which was pretty surprising actually. But I guess we're going to look at the positioning to check that out next. But why don't you keep going?
Yes. So that was options and just volatility. So looking back to volume, so this is data compiled by the officials. They look at, so if you look at my chart here, they look at average daily traded volumes for the week ending, again, for last week. And so these are changes from the week prior and the year prior. So Brent has done well in terms of trading volumes for the front month, for the first 3 months. WTI, on the other hand, has seen a week-on-week increase, but remains subdued relative to last year. Heating oil has been interesting. I think heating oil and gas oil we have seen interest been a lot higher than it was last year, but heating oil has seen some de-risking this week, which I find pretty, not de-risking,
Sorry,
but
what's the
just
difference
less
between
interest this week.
The top and the bottom one?
So the top one is changes against last week, the week prior. So last week's trading volumes versus previous week. And the second one, discrepancy indicators, is changes against last
So we
year.
had a big de-risking, a big post-event lull, just wanting to stay out of it. Some holidays probably I know how everyone felt, right? They're like, it's time to take a breath and chill out for a bit. So that completely makes sense. But the volume's been building back up. It's no longer an options-driven market. People don't really need that insurance, can't really see the tail upside or downside, really. So it makes sense that people are starting to more invest in the outright contracts again. So that all adds up. So cooling, I think it did cool down. I think it's kind of picking up again steadily. I mean, we're getting towards peak summer. So I think this is where people expect the peak demand and that story to come to fruition again, all that kind of crap.
Interestingly, RBOB still seeing less volumes compared to the previous week and the previous year, despite it being peak summer.
Do you think that's partly due to just the focus on distillates, and a lot of the kind of RBOB volume is kind of, what's the word? The sort of marginal RBOB volume can flip to heating oil if they think there's more money to be made in heating oil. Kind of funds will just allocate more resource to heating oil. I mean, I don't know, but that would be my kind of hypothesis. Is that
when you speak to people who trade the futures, they are changing them interchangeably. It's kind of like they'll do WTI and RBOB a bit, but they're doing RBOB heating oil predominantly in the US, right? There's just such high volumes in that, and because we don't really know that many traders in Europe who trade heating oil, right?
But it's an enormous spec market there, right?
Spec market. This is US driven. So I agree with you. They're kind of like interchangeable. There's been such a hot market in heating oil that I kind of see that logic completely. I remember the big gas to heat trades. That's always been a huge trade, and I guess people have been so burnt on that. As you say, they're probably just like, well, then why would I be invested in RBOB, right?
Yeah, just kind of buy heating oil.
Okay, so now we'll talk about what's driving the market. This is the herd mentality.
So as we have alluded to it, the strength in heating oil, the fact that it's keeping margins up, is definitely driving the herd right now. As you said, it's no longer an options-driven market. We don't really have event risk. All eyes are on what is driving the distillates market. Why is it so strong? So if you see over here, for example, we are starting to see resistance, as I think we were talking about this yesterday as well, last week's price action. We saw that climb into the $20 handle. This is for the August versus September spread. We did see that increase. Now, this particular price action is also interesting because I was talking to our options trader, and he talked about how there's been a lot of trading in gas oil calendar spread options as well, so CSOs, which are basically options on the spread between two futures contracts. So there was a decent amount of call CSOs being bought by one individual on Thursday, which was when we saw, and then they were immediately in the money, as you see in that spike over there. So I think the fact that we sold off from there must have been a function of both sell-side interest at those levels alongside some profit-taking by the fact that these options may have been in the money at the time.
Yeah, I mean, going straight to the spreads, it's quite niche. But I think just sticking on the cracks for now, like that's had such a big rally in the war, and I think there's a bit of a hangover from the Russia-Ukraine situation with Russia being taken offline. The biggest move really was gas oil, as well as Brent and all that, but $40 on a crack. And you are taking quite a staple supply offline when you reroute, when you take out Russia into Europe. So that all made sense. But I guess we're kind of going back to that narrative a bit. The recent talk with sanctions, I think the EU have sanctioned them again. They're just basically they're just hyping up on already hyped up market in distillates. So that's interesting. But I can't help but look back to the beginning of the year when we were doing these podcasts. In fact, when we started this new show, we did point out the low distillate stocks. But I remember us just being like, yeah, who cares?
Yeah.
In retrospect, it's kind of weird why you would say that.
Well, I think at the time, like we were sort of, the general like narrative around the sort of global macro sense was just like so bleak.
Yeah.
And now it's like, hypothetically, looking back, it's like, okay, fine. Like Donald Trump was just talking shit a lot of the time, but like at the time, it did feel a bit like it was like, where's this going, basically, and like.
But it's always a reminder to a trader or to a spec trader, even if you've been in the industry for, I don't know, decades, that you still don't know. You still get caught up in narratives and sentiment, and like you're looking at like really clear evidence. Distillate stocks are below the 5-year like low in the US. Turns out they're low in Europe and they're low in, and we just weren't talking about it because everyone was so fixated on this bearish narrative with S&D models. And again, why look at forward S&D models? They just tell you nothing. Like they've just literally told us a complete opposite of what's happened. I hate them with a passion. no validity in the market. So case in point, like we were all completely blindsided by a market that's now driving everything. And, again, you come into summer and you think it's all about gasoline. And we were saying the market with gasoline was quite bullish all the way throughout the year. We're like, it's doing quite well. It's quite steady, making good, easy money here. And it tapered off. And all of a sudden, distillates is the summer, which is very unusual. It is the driver. So anyway, it's just a reminder, like, you'll always be, you always think you're experienced and you've seen it all before. And you just always get another reminder that randomness always happens.
And like the gas to heat trade was really popular this year. The kind of long gasoline versus heating oil trade was really popular. So it felt like,
well, this is what I was going to say. Sorry, so you had the war, and it's all made sense. This time round, if you had got another war with the Iran situation, so it was generally a war traders to buy distillates. I think that's kind of a fair thing to say. And especially so recently since the Russia situation. So people bought into that, and then there's a lot of short covering on distillates. And as you say, gas to heat, there's a huge stop out. So selling back the gasoline and buying the distillates. And then we knew there was a huge trade house that had a huge stop out in the front. So it all said to me, okay, well, it's a stop out. And then it's over now. And if anything, you sell into the stop out or buy into the stop out for gas to heat. And then it turns out people got stopped out again on that trade recently because actually now the fundamentals all came into play and the prompt was very strong. Mita points out the time spread. Why is that important? Because it's the prompt physical premium. That's what the time spread's showing you, like one over the other. Like, are people in demand for this? Do they want you to store, or do they want all the oil that you've got in storage? And that's effectively what the time spread's showing. And it's unbelievably high. So that plus storage being so low, I don't actually know the demand statistics, but it's now no longer a stop out market. It's a genuinely strong market. So people are actually getting long these cracks and long these spreads, which feels weird at such a relatively high level. But I guess that's what's caught the market so offside.
And I think we did say like briefly last week, but the fact that you had like a physical expiry, like a physical gas oil expiry at like $60 or whatever, which was previously in the day was trading north of $100. That's like a real sign of like a genuine distressed physical market. Is that like on the, people, there's demand for physical distillates at like a $60 a ton premium, $100 a ton premium to the next month, basically.
And I think we need to talk about the ramifications of gas oil again with the refinery margins when we get to that section. But for now, we're going to cross to officials where they've been tracking this Murban situation, the physical oil out in Abu Dhabi, and its ramifications. They've been driving the kind of headline media news there. A lot of outlets have been picking it up, and it's been a very interesting story. So kind of into its 4th or 5th week now. So hi, Ed, Spiros. Do you want to take it off from there? What's been going on?
Yeah, sure. So as you said, we've had another update to this whole Murban episode, and we asked Platts for a clarification on their proposed methodology change. So I think it's worth at this point reminding everybody of the existing methodology. So just summarize that quickly.
Yeah, so the current methodology right now is that if the average, the 15 business day average of the Murban on spread is pricing over $1, Platts applying a 50% quality adjustment.
Mm.
But there's on the downside, there's no quality adjustment. So there's no flow, but there's essentially a
Yeah, so if you have Oman pricing more than Murban pricing more than $1 above Oman, which is a key feature of this methodology is the Oman aspect of it, then you have a compensation factor where the buyer has to compensate the seller for nominating the Murban into better quality grade. And the proposed change is therefore that when Murban prices below Oman, as it has done frequently, and we've got a chart here where in May you can see it's frequently pricing below the Oman pricing. The seller will have to compensate the buyer for nominating a Murban cargo with 100% of that spread over an average of 5 business days previously. So if you have Murban pricing, say 50 cents below Oman, the seller will have to compensate the buyer by 50 cents. There's no minimum threshold. There's no 50% of the spread aspect to it. So there is this imbalance in the proposed methodology between the upside and the downside, which creates this kind of bias towards the upside because of the imbalance in the mechanism. So recently, you've seen in July, we've seen that spread has tightened after it hit out in June as ADNOC revised its Murban exit plan. And so we've had a few days. So the last 5 business days, for example, Murban has been pricing on average 1 cent below Oman, and that means that the seller would have to compensate the buyer for nominating a Murban cargo into the Platts system by 1 cent per barrel, and that wouldn't be the case if Murban were pricing above Oman. So there is this imbalance in the system, and the Oman problem is one as well because, as you can see at the beginning of July on this chart, the Oman to Dubai spread is actually positive, and Murban is pricing above Dubai, and yet the seller would still be having to compensate the buyer.
Yeah, exactly. And there are those consistencies we've been talking about, but there might be some disruptions in the Oman field, for example, that could affect the Murban-Oman spread.
Yeah, right, because if you have a disruption to Oman production, then you can see Oman pricing jump.
Yeah.
And that won't necessarily be reflected in Dubai if that's being set by Upper Zakum, and therefore you could end up having a situation where Murban is pricing below Oman, significantly above Dubai, and yet you're still being punished for nominating a Murban cargo into the system, into mechanism.
Okay. And obviously it's really important because in March, for example, the beginning of the month, everybody was nominating Upper Zakum cargoes when they were reaching convergence, and then once the Upper Zakum was drying up, the ships were shifting to high quality grades, so they were shifting to Al Sakin, then Oman, then Murban. So this creates also some sort of supply disruptions in the Dubai benchmark. Right?
Yeah, it's a liquidity problem. There are a whole host of problems. The Platts consultation is still open until the beginning of August, so hopefully we'll see some further revisions to the proposal.
Okay. All right. Thanks, team. Okay, so now we will look at the wider themes going on. This is the macro mayhem section.
So just to start off with macro and fund news, I thought I'll start with positioning. So just ICE COT data for the week ending, this was for the week ending 15th of July. We saw in Brent, money managers, that is hedge funds, they added nearly 16 million barrels to their long positions and removed 3 million barrels to their shorts. If you see my chart over here, you can see that increase in net positioning. So net long positioning, that's longs minus shorts, increased to its highest since the week ending 1st April, which coincidentally was the week right before the pre-liberation tariffs and that massive sell-off that we had in Brent, which is significant. WTI, interestingly, did not share Brent's fortunes. You can see this with WTI. There's a pretty significant decline. We saw money managers liquidating 33 billion barrels, that's around 70% week on week from their long positions, and adding 21 million barrels to their shorts. That was a week on week increase in 41%. That's the largest percentage increase in money managed by money shorts since the week ending 3rd September 2024. That's just on CFTC. And you can see this decline, this divergence in Brent and WTI and Brent in this chart over here. For the week ending 15th of July, you can see this decline in price action. It has seen more support since, but this week also dovetailed with the large crude. We saw 7 million barrel increase in crude inventories in the US. The week after that saw larger than expected increases in gas oil and in distillate fuel oil and gasoline inventories. So I think just sentiment in WTI may have been a little more subdued than it was in Brent.
Yeah, I guess that would explain the sell-off then. So the only thing you can really say is who took the other side. So US sellers, yeah, I guess maybe on the Trump narrative, it's a very hard one to tell why you would be so bearish Brent other than just a kind of arbitrary Trump wants the prices lower.
Yeah, I'm not really too sure. I suppose maybe it's a bit of a reach, but I guess if you've seen in the, like at the start, the kind of heating oil volumes, more like selling in heating oil, like decrease in longs and heating oil. But at the same time, you had the kind of like European gas oil, like roofing still like open interest. Do you get it where the kind of underlying crudes that kind of support both those products individually kind of benefit from the like open interest just as a sort of byproduct of people actually going after the products, and like vice versa, people kind of liquidating the products in heating oil?
Yeah, so that we don't want to put the risk in the outright.
Does basically WTI suffer because heating oil suffered that week, and does Brent benefit because gas oil benefited from from the kind of market makers who would take the other side of that position, basically?
I mean, generally speaking, you do tend to get a positive correlation with distillates and crude, right? So
yeah,
I do see what you mean, and I would say,
but like the kind of market makers taking on that kind of distillate flow,
right.
Would they be buying Brent against it? Do you get a kind of like a correlation in the actual open interest as well?
Yeah, I definitely. I would have thought, yeah. I mean, that you have to hold it against whatever pair you can find, right? That's like liquid and all that. So no, for sure. I mean, we know that, right? I mean, if anything, you can just take that all the way through. Like something huge happens in heating oil, it filters through to WTI to Brent, which filters through to the products, which filters through to the cracks, the time spreads. Everything gets impacted by everything.
Yeah,
and that's why you're sitting here going, so what actually is what's caused this sell-off? Some numpty comes out and goes, oh, it's this headline. It's like, headlines don't drive markets, traders drive markets. What caused people to sell is one thing, but they sold.
Yeah.
Who sold? Which contract? Why?
Yeah.
And sometimes it's a bit of a maze to go figure out in which part of the...
Yeah, and I guess for the sort of viewers and listeners, that's when we say things like it was like a distillate-driven rally. Like I think last week we said it's like a gas oil-driven rally. It's kind of what we're talking about, isn't it? Yeah. Like it's not that people didn't buy Brent, it's that people bought, like gas oil was the one that kind of was the impetus for people to buy Brent. Like gas oil was what brought everything up.
100%. And I think you could take that to the next step, which I think there is an example later on. But, generally speaking, people always also give way to that flow. So in other words, differentials to that main flow suffer or whichever way around it is. The big trade I always pointed out in 2022 was low sulfur fuel oil versus gas oil was in a decently tight range for a long time. People were moving their desks in fuel oil to link with their gas oil teams because there was this very strong correlation and all that. And then suddenly they just massively broke down. Like the diff went like way through all-time high lows and just kept going lower to like stupid levels, to the point where it was like, okay, this differential doesn't really have any function anymore. Because the gas oil buying was so strong. Like no one cared. If anything, you're going to sell that diff just to give yourself long exposure to gas oil. And that's where flows can be so dominant. So like 100% agree with you on that. But anyway, we're talking about the macro side. So that's the hedge funds positioning in oil. But
so we've got our own CTA data too.
And now the CTAs,
Yep. So just to show that as well. So we do see that increase in CTA net long positions in Brent futures. That's that orange line over there. Sorry, that blue line over there. And we do see that increase in the week ending 15 July. But then again, just because this is more timely data, this is until yesterday, we do see those positions peter off over the following week, which is fairly in line with how price action has also been.
WTI CTAs have just flipped short as of just 2 weeks ago.
Yeah.
And Brent is actually
Brent's just
Sure.
gotten more shorter.
Just never even got flat. Never.
No.
Yeah. Okay, that's interesting. I thought they'd gone long at some point. Okay, but either way, maybe that was why that was overall. That was on all futures. So this is just crude.
Yes.
So yes, you've had a decent amount of selling pressure from CTAs as well, like a few thousand lots. It's not nothing. Okay, maybe that would have added a bit as well. And it's certainly going to exacerbate a move down, as you say, Harry. Like the open interest is thinning, but these guys are always quite active. As prices go a bit lower and as they get more into it, they're going to be like selling into a kind of a vacuum-y type thing, right? So this is an example of where markets also following on from what we're saying can get whipped around a bit by nothing. Just like one high conviction player, even an algorithm, is enough when the market hasn't really got strong conviction to whip around the market. And we're sitting here going, why would you be selling Brent right now when everything is indicating up? That's why sometimes there can just be a high conviction flow that no one can absorb. And actually, I do kind of feel that a bit with gas oil. It's like, well, no one, I don't think, saw this rally coming. I might be wrong. There might be some huge player out there making a lot of money, but generally it felt like a lot of the market was positioned the other way. And so, and again, it felt like this in the Iran situation as well. People were short covering and protecting themselves with options. They weren't getting long. Yeah. And then waiting for the sell off and then did okay that way. It felt similar with gas oil. So now, you know, if you get a high conviction buying flow in gas oil, it does quite a lot to the market because the market has already taken it on and not fared very well. Yeah. They haven't bought in, they haven't really done anything. So
yeah, it's like the thing that people are scared of. And when they see it happening, it's like, oh, this happened. It's like,
yeah, just stay out of the way.
Yeah, just stay out of the way. Yeah.
And I guess volatility has to go up in that scenario. But having said that, there's a heating oil CTA now, I remember in our notes.
Yes. Yeah. Heating oil has been really strong on the CTA side. Yeah. So just to echo what you were saying, this has also been a algorithm driven market. You have seen, so we did see some positions come off just between 14th and 17th July, but then they took off again and now are higher than before that sell-off on the 14th. So this,
I mean, it's not a highly intelligent algorithm, right? It's just trading on momentum indicators, but but nonetheless, it's acting as I would expect a trader in the OTC market when they know they've got the market on the back foot. This used to be a classic thing in market making. You find like a weak point or a strong point where people can't trade it. You get enough liquidity to get into that spot the right way, which is quite hard. And then you're really trying to sell every bid because no one can like basically buy it off you, and it's definitely going to go south. So you're trying to fight for that liquidity on the way down. And in turn, you're pushing the market lower, and it just becomes a spiral thing. So a CTA doing that in the market's face, it's like acting like a human almost. It's like no one wants to sell this, and they're like, well, there's momentum, and we're going to keep buying. And every time they buy, everyone's getting more and more like, and then they stop out for the second or third time. And it's,
I guess it helps for it to be that simple, for it to just be a momentum
algorithm. It doesn't need justification.
It doesn't think emotionally, doesn't think in terms of the stop outs that happen. It just thinks positive momentum will buy, and it has.
Yeah, but I'm saying the market behavior it's causing on the back of it is fear, basically.
Yeah.
And now we're all turning around going, the narrative earlier on the year that we discounted, and now we're going to make it like it is valid. And now we're justifying the rally because of bullish fundamentals. It was like, well, it was obviously never really about fundamentals. It was just a misweighted sentiment. Probably it was just disjointed and dissipated and ignored. And suddenly we're all paying for it.
Yeah, that's a very good summary.
All right, so back to what we were saying. So this was, where were we at? Sorry, we were finishing
just circling back to, there isn't a lot of macro news that's coming out this week alone, but the market is still going to be looking at the EU's trade war with the US right now, especially with Trump now saying that any negotiation is still going to include above 10%, above 15% baseline tariffs, which could be pretty damaging, especially for, say, German cars, for example. So again, that ties back to manufacturing, oil demand. So we'll see how that shapes up in the coming weeks, but especially with the 1st August deadline coming up, I don't know if Trump's going to postpone that further. For now, they've said no, but that's the only macro driver that I can think of for this week. But fairly interesting on that as well.
Well, again, going back to distillates, as you said, like distillates is the economic demand for cars, trucking, agriculture, and it does show people out there who think that we don't need oil. Like, look at why we're so tight in diesel then, when like apparently the economy is weak. Like we use this stuff all the time. We're running at a shortage. It's the worst time to sanction Russia again.
Yes.
And this whole Russian Indian oil, I think we moved away from being like, we don't want that. Well, okay, we're not going to have any distillate then. So it's the same old shit.
It's sort of like a weird like balance of scales thing. We've got this whole sanctions thing on diesel on one end and potential tariffs that could significantly impact the German manufacturing industry on the other hand. So let's see which.
Yeah, and like what we saw before was basically all that diesel just getting rerouted via like the Middle East and
India, and that's what they're targeting now, if I'm not mistaken.
They're trying to figure out where we actually did buy it from that was still Russian diesel, basically.
Yeah. Well, I just think
it is really difficult to determine exactly where your crudes come from. So I wonder what the practicalities of that would also look like.
We've been through this. I mean, this is old news for everyone. This is just no one wants to hear this stuff. But I guess it's politicking. And I mean, we don't want to be adding to the fuel of like Europe and UK are dead. But this is the kind of stuff that people latch onto because it's like you're just making things worse.
Yeah.
And it's almost boring now. But anyway, let's move on because I'm depressed.
Oh yeah, Jorge loves to do that.
I know.
Give you a slew of headlines.
Yeah.
But yes, to get back to the hedge fund news, so we've got a couple of interesting tidbits here. So there's news come out that a group of Millennium and Gutenberg Group veterans are now setting to debut a new commodities hedge fund with $715 million at launch. So they've got a day one investment from New Holland Capital as well. I don't know if those are.
Yeah, Scott Harvard was a big trader at Glencore.
So we've got
He's gone on to Millennium and then and now he's doing this. Yeah, to raise $750 million in this environment, it's like not bad. It shows you the demand's still there, right? I mean, for oil, power, and gas in particular, but I guess commodities. I don't know if that means they're doing metals as well. But no, just good indication that there's still healthy demand for capital to be deployed in this space. Right?
Do you think that this would be like a kind of futures fund, like a futures fund, or were these guys trading swaps as well?
Yeah, I think they're doing everything.
Right, okay.
If I'm not mistaken, I think one of them was like one of the big derivative players in the trade house. But anyway, I don't know. I can't say like I know. But I just think it's when you're trading 750 million, okay, you can have ways to leverage and get interest income, 4%, whatever. But you expect it to make like at least 10, I would have thought, like regularly. So to make 75 to 100 million a year, like there's not, you're going to need to deploy in quite vanilla structures, quite scalable liquid contracts. Kind of has to be a futures trade, really.
Yeah,
right? People do make a lot of money in swaps, as we know, but as in like to do it reliably and
it's more of a finite space.
Exactly.
Yeah.
Exactly. So yeah, super interesting. But again, adding to the growth. But we were a bit annoyed about hedge funds in a way because there were just too many of them and fighting after the same liquidity. But that felt like it was unraveling a bit, and all the obvious trades just being long basically and propping the market up, that went away kind of basically with the Trump scenario. So now we're back to a more, I would say, even though the Gasol thing was unexpected, generally speaking, a more orderly market, a more free-flowing market. So maybe the market could probably take another hedge fund or two to coming into this space. It's probably not going to be like it was before. But
on that note, another hedge fund is joining the commodities market.
Yeah, okay.
So Cube is another, it's a London-based hedge fund that's entering the US now. So they're a multi-strat, multi-asset hedge fund, and now they're entering the commodity space, starting with the US. So I think they're opening shop in Houston at the end of Q3, is from what I remember.
I thought these guys were already active in the UK.
They are in the UK, so they're entering. So I think they're multi-asset right now. So they might be looking at commodities.
Oh, okay. So I thought you said they're entering the commodities space.
They are, but in the US. So they're opening like a commodities from what I think they're opening like a commodity specific trading hedge fund in the US, in Houston.
Okay. All right. Now let's move to kind of more the fundamentals again. This is the crack spread Chronicles. Okay, so refinery margins. I mean, this is the hot topic all year. Again, I felt like this was a flash in the pan a while back, and it's slowly more and more become just the biggest driver. So what are we, depending on your calculations, our benchmarks $10 plus on the prompt. Very, very healthy margins no matter which way you look at it.
I can show our benchmarks to everyone. So we've got this for Asia, US, and European refinery margins. They have been strong in the prompt, as you can see over here. So these are weekly and monthly changes across the curve for all three regions. This has been especially significant in the US and in Europe. As you can see, the US has weekly deltas have been fairly significant in the prompt in both those regions. Asia has seen relatively more subdued changes this week, with like M2 onwards seeing weekly declines and monthly declines, but the prompt is still fairly holding up in Asia as well.
Yeah, so they're rolling up these margins, which is unusual actually. You could kind of think, oh, it rolls off. I think that a bit of our narrative was like, we think there's some real tightness in the front, actually driven a lot from fuel oil. Do you remember we were talking a lot about that?
Yeah.
And saying, look, this will probably roll off strong, as in they'll stay strong into pricing. And then next month will fall lower in refinery margins, reset there. And that will be in turn like pricing in a bit more of an oversupply and that kind of thing. But actually the reverse is happening. Well, it is pricing strong as a refinery margin, but then the next month is rolling up strong again and rolling up strong again.
Yeah.
So this is just the biggest indicator that you're in a super bull market. I mean, there's no other way to say it. So I think this is what we need to talk about. So this kind of acknowledgement of the truth. So remember, we were talking a lot about fuel, obsessive topic for a while. We finally gave way. Gas oil's replaced it as the stronger of the margins. So let's look at it from a supply and demand point of view, as in prompt, not forward speculative nonsense. What has happened, I think, from our like internal debate is, you know, we know China have been basically taking a bunch of excess oil, maybe planned directly with the Saudis as part of a wider, you know, game or whatever it is. They've absorbed the excess and they've brought it inland, stockpiled to, you know, near to all-time highs for them, all that kind of stuff. But the problem is that the refinery utilization in China has been low. It's like 50%. So this is the whole thing about like trading all these things. You said about everything connected from a flow perspective in the derivative market. Well, in physical, it's the same in a way, but you know, you can't just look at crude oversupply, undersupply. You need to look at the wider market. So generally speaking, if we think things are oversupplied, then you should get stock builds. And we have been getting stock builds, but then you expect those stock builds to be utilized by refiners and then put into excess refinery stocks. But we haven't had that build in refined product stocks. If anything, distillates has been woefully like underfilled. So yes, going into this year, people are saying the demand's not that strong. And your refineries look at these things, right? And so the same with producers, and we've said this in the past, shale oil producers won't hedge if every bank and every analyst is saying oil's going to 120. Why would they sell? So then that really screws up the market in turn.
Yeah.
So I think if you're coming into this year and everyone was saying the demand's going to be lower, like the oil market's screwed, whatever. Okay, China's just looking to buy excess oil and store at a relatively low price, the price that they like. But why would they convert it to products and sell it if there is no perceived demand and they don't need it internally because their economy is crap. Their product quotas, I don't know this off the top of my head, but I don't think they're particularly aggressive. They're not flooding the market with products. So you're just getting the situation where you have taken the excess of crude, but that doesn't mean it's actually just tighten the market because then you've not refined it. And it's this weird like balancing act, like ultimately that's what a balance is, that we've like basically not factored in because you kind of make the assumption crude bought is crude refined, which comes out somewhere, and it hasn't. So the market's really been missing this refinery utilization. And again, it was weird because we always talk historically about refiners setting up and the complexity and everything geared towards creating diesel, and it's just not happened. Super interesting, basically. But that's how I'd summarize it. Basically, need China to start refining.
Yeah, because I think, you did say it, but I think it's weird that we've been talking the strong margin picture for so long, and now we're basically saying that there's just, things haven't been refined enough. Because we always, like at the start of the summer, we were kind of the assumption we're like, this is going to lead to like product oversupplies and stuff. Why would you not just run 100% with all these margins?
Yeah.
Now we're kind of back into the summer and like, what the fuck's been going on, basically?
Well, if anything, refiners are closing down.
Yeah.
And like Lindsay, I know it's a small one in the UK, but generally speaking, I guess Europe not wanting to refine. Man, I was reading David Cameron's autobiography, and like I got 2 pages in. He's like, "I'm so proud of like our emissions are the lowest they've ever been," and all this kind of stuff. I'm like, mate, all you did was export emissions somewhere else. That's not. You don't pat yourself on the back for that.
Yeah.
And that's what Europe are doing right now. So we won't refine it. Okay, so the world has to refine it. The world maybe doesn't want to refine it, like China, and you don't get the oil coming back. Or if you do, you have to pay a stupidly high price for it.
Yeah.
So many dumbass decisions. But anyway, that's another example of like, we have our rules, don't we? We assume profitable margins, you run at 100%. China never play by the rules, right?
Yeah.
They've got their own fixed level for refinery margins or fixed refinery product flat price that's in their domestic market. And then the crude's the variable. So obviously crude gets lower, their margins get better, and they'll slowly make these changes. But also they can just do what they want, state owned and all that. So they don't have to. Maybe they want to starve the world of refined products.
I was going to say, they've always, it's always kind of in their interest for the West to not be like, in a good position. So we're basically like openly just being like, we want to export all this stuff. Then they just be like, okay, fine. Well, then that's just like one bargaining chip for us and one less for you, basically.
It could be. I mean, I don't know. I just get. Sometimes it's a fine line. Like
it's easy to go down the rabbit holes.
Conspiracy, but
just to give context to like our viewers as well about how much China has been building in aggregate, non-OECD countries have added around 100 million barrels to their inventories from the end of January this year to the end of June this year. Of which China has added almost 50 million barrels alone just in this period. So just to give more context about how much they've been adding to their inventories.
Yeah, and then Morgan Stanley said something quite interesting a couple of days ago about, do you want to just summarize that? Have you got that there?
So again, just to look at how I've just talked about non-OECD countries and how they've been adding to inventories. On the other hand, ARA stocks and the US, if you look at my chart here, we have talked about this in previous podcasts as well, but they are low, these stocks, especially if you look at distillates over there, like in gas oil, for example, and in the US as well, distillate stocks are below the past 5-year range that we've seen. So this is fairly significant. So, and these declines are important considering, as you mentioned, Morgan Stanley's recent note, that observable oil inventories have built by 235 million barrels between the end of Jan and in the first 6 months of the year. And only 10% of this has shown up in commercial OECD storage, which is very important for pricing. So that's...
Yeah, so to explain that, I know we always talk about this, but this is why benchmarks are so important, because it's about the local region that's priced, and then that's gains a lot of liquidity and it's used as a proxy, right? A benchmark for everything else. But there might be localized strength or weakness, and then that in turn prices everything else in the world, which is very frustrating for someone. I mean, you get it all the time. I mean, gasoline traders not so long ago were like, you cannot buy, actually it was a while ago, but they were like, you cannot buy gasoline in the physical market, but EBOB's going lower. So they're getting long EBOB because they're thinking, well, speculatively this makes sense because there's no supply, but EBOB's going down because of the localized pricing impact. So I actually get that. And I think that's actually pretty good, useful analysis from Morgan Stanley. So rather than harp on about all this like theoretical stuff, that's actually quite intuitive, because it's like, well, here is an explanation. There you have been building. There has actually been a bit of an excess in crude. But like I just said a while back, it's been absorbed by China. But not only that, other OECD countries. And where are the benchmarks? So the benchmarks in US and the benchmarks in Europe predominantly, there's obviously R-Sync benchmarks, but they're nothing in terms of liquidity compared with WTI and Brent and gas and all that. So I actually buy that. I buy that quite heavily, but it still doesn't matter, right? I mean, that's why people get so like dumbfounded when WTI goes negative, or WTI has these massive like blowouts to like plus $2 on the spread, or the same with Brent. Is that you've got to look at that region, and it doesn't matter what happens in the world. You can shout and scream all you like, but if Cushing storage is low, prices will rise in WTI, and it looks like that's just what's happening in the distillate market. And I feel that stupid in a way for not really realizing it earlier. But as I say, it's just the wind, the blows and the narratives, and you get caught up in it. But I think, the ARA one for me is a bit more interesting, because that's where you get like pretty decent physical squeezes, basically. And the spread doing what it's doing right now, and only what 6-7 weeks, that's that could get pretty scary pretty quickly. And then if traders are long enough, the derivatives, and they've positioned themselves quite nicely, they're kind of not incentivized to supply the European countries. And if European countries aren't making it themselves and need to buy internationally, it's like playing into the traders' hands like massively. So that could get quite nasty.
Yeah, especially on gas oil when you've got such a prompt delivery. Yeah. So it delivers, it expires in the delivery month. So it's like basically like a spot expiry in delivery. So if you need the barrels, like
goes to the moon.
It's kind of like what happened when WTI went negative. It was like people just like categorically could not hold that contract into expiry. So it's like, doesn't matter what the price is, like they have to sell it. And it's the same with this gas oil contract. If you are short and you need gas oil to fill another short, like along your chain or whatever, like you need it. This like spot physical. You can't wait for it to come from Asia or anything. Like you need to buy this.
100%. And back on this talk about us not seeing this coming, and even I think we even had a short gas oil trade at one point. It actually did all right.
Yeah.
It's just, remember, you've got to factor in when suddenly the attention's on something, the Dark Knight effect, when they all went nuts, like the in supermarkets and all those stories where people kill each other, like in these scenarios of like scarcity.
Yeah, everyone's good. Everyone's nice to each other when things are all right.
Whatever the things are, like our scenarios were like in COVID or early COVID. Remember the toilet roll thing in the UK, and then we had a petrol crisis because there was this report that we weren't going to have enough petrol, and everyone went nuts and just like paused the shortage.
Yeah,
and that's something we've got to remember, that in like we were ignoring this narrative so much that now we're saying, no, this is so bullish, like we're buying into this hype, and everyone's buying into this hype, and then that's what causes the carnage. And then the buyers who actually have the distillates are like, well, this is great, I'm going to fuel this hype if anything. You can't really call it a bubble, because it's just like, no, it's in demand, but the demand has been boosted by the scarcity bias, the scarcity psychology. That's scary, man. Like, and that's why we get these dramatic things around the world.
Well, hopefully we're not responsible for like a bank run on distillates.
Well, if anything, it's like, I don't want to be responsible the other way, right? Because I'm saying all these things, but this is when you're on the losing side of a trade or a narrative. You don't know when to stop out and be like, okay, I was wrong. But are you wrong, so now you're bullish? Or are you wrong just like, I think the best thing is
on the sidelines,
but then that's clearly what the market's done, which is why it's so volatile. But then remember, there's real pricing going on. There's real physical impact here. As I said, the trade houses, the people who actually want to source physical distillates and know what to do with it, they've got what the world needs, and they're not incentivized to sell it to you unless you're paying a high price. And then it's quite, you kind of do need to buy to protect yourself. If you're in a hedging scenario right now, but you kind of got to hedge, because if you don't, then you're not going to do what they want, what they need. So a case in point, like I remember one of our traders a while back was like, he had such a big part of the market's liquidity. He was like, I feel like when I stop out, like the market then goes the other way. I'm like, of course it does, because you have so much liquidity. When you finally buy it all back, the market's got the liquidity it needs to go, okay, I don't need to do this anymore, let's sell it back down. But if you don't give it that liquidity, it will keep going higher. So yes, you could go and hedge right now, buy up all this gas oil. The physical trader is like, okay, my trade where I've been sourcing, all the diesel I can and holding it back, I'm now satisfied. You've hedged, like the price is at a reasonable level. I don't think it's got much more in it. All right, I can just chill out now and kind of steadily supply. You see what I mean? If you don't have that stop out, even on a physical sense or a paper sense, then they'll just wait. I mean, that's kind of what you would do, right? So it's funny dynamics. You almost just have to admit you've lost. Rather than just wait for everything to come back. That's almost the worst thing you can do in some respects.
I see.
All right, so lots going on there, but let's now talk about where people have made money. This is the gold rush.
So I know a lot of people have also lost money on heating oil and gas oil, but a lot of people have also been long this past week and in the previous 2 weeks, and I want to concentrate on that part.
So fast money longs finally thought, okay, maybe I believe in this.
Exactly.
Okay.
If you look at just official COT data as well, so the yearly average for net positioning as of this week has been negative 9.4 million barrels. So just that shift from how negative the market was to how positive it has become at 41 million barrels now for the week ending 15th of July. It's highest since October 2021. So that's where net positioning, that is longs minus shorts, is right now. So that does show that people have made money off of this as well. And obviously this is a lot more evident when you look at the CTA chart and how
well the algorithms have definitely done well. That's for sure. They're the winners. The robots win. They always win.
They always win. Yeah. Just looking at demand, you were asking whether this is also a demand side story. And demand has been, so this is in the US, if you look at just product supplied, which has been a proxy for demand for fuel oil and for different refined fuels in the US, distillate demand has been fairly on track with the 5-year range. It's not been too stellar. So
it's a supply story, not a demand story.
It is a supply story, definitely.
Okay, you were just adding that as an anecdote, right?
Yes.
Okay, cool. But back to who's made money.
the other place where I've seen people make money, but on the other side, is marine fuel. So this is Singapore 0.5. This is the August Singapore 0.5 crack. And if you see our data over here, we have seen trade houses be net short for quite some time, but add to their positions fairly significantly this week. And back to price action. So it has seen a little more support just today, but it's still fairly weak. And just before this sell-off happened, so just before this particular decline happened over here, we had this in our report, which I would like to highlight. So this is just a bit more on the technical side of just the sell-off that we saw. So the two things, so in blue, we see a descending triangle, which just essentially shows the consolidation and price action. And so such consolidation, it shows that volatility has been declining, and it tends to precede an outbreak in either direction in price action. And a descending triangle, basically just a triangle with a descending slope, tends to signify a downside breakout, tends to signal a downside breakout. On the other hand, in yellow, we see a traditional head and shoulders pattern, which is essentially, so the market psychology there is just that second peak, which is the head of the market, where I've made that arrow, tends to happen on low volumes. So that just shows that the strength is starting to peter out in the market, and you are going to start seeing a sell-off instead. Very interestingly, momentum indicators started pointing to the sell side around that third increase over there, the third head of the market. And that's when we also saw trade houses selling on our COT data. So it was that's when we put out trades shorting this contract.
So the trade houses have been short from around like 11.50,
so they've
12,
been
11
short for a while, but around the 9th onwards, you can see this decline in trade house net positioning.
Okay.
Now let's move to where we've lost money. This is the Widowmaker.
So we did talk about this a little bit in just, I think, 10 minutes ago, but just in terms of gas oil and differentials to gas oil. So we're going to talk about the Singapore regrade contract, which is a Singapore jet fuel or kerosene versus the Singapore 10 ppm gas oil. So just with how strong gas oil's been, this is what's happened in regrade, in the front month regrade.
Yeah, so this is classic, right? That's what I'm saying. So you buy gas oil, all the strengths in gas oil, differentials to gas oil, tightly linked differentials weaken because it's just a proxy for getting long distillates. And again, a differential is a relative value thing. Jet can still be very strong, but is it as strong as gas oil? So generally speaking, yeah, you sell the regrade. And I've been there myself trading distillates 10 years ago. And I think the regrade got to all-time highs for the opposite reason in Singapore, because people were selling the EFS. They were selling the East-West contract because there was there were ships, but it was so tight. And basically everyone was scrambling to sell the East-West, because if the shipping costs were too high, then the arbitrage didn't work. So the price needed to go lower in order to incentivize more arbitrage. So every day they were just selling, so they couldn't get liquidity on the Sing leg. So people were just spanking the East-West, selling Singapore gas oil, but they're also buying regrade in order to get a short exposure. And so regrade went to all-time highs, and you had all these Platts stories like, oh, Jet's so strong. It wasn't strong. It was just stronger relative to
it had moved much, but gas oil had dumped.
Yeah. So the differential went to super high levels. And then of course, when it got into pricing, like the regrade got smoked, but the physical came in. But that's classic. And it must be a tough thing to navigate being a trader out there in the Sing market.
So just in positions against Onyx, we have seen trade houses be long this contract, which I'd assume initially would have been away. They had trimmed some of these positions, which could have been selling to get long gas oil, but just using this contract to get long gas oil. But they have since added back to buying the contract. And considering just the decline in considering the decline in regrade since and the increase in Singapore gas oil cracks over here, these long positions are not profitable on their own.
Yeah.
Okay. All right. Well, then that's that. Let's now move to going forward. This is the crystal ball. the interesting one here has got to be gas oil, right? The gas oil crack, which we look at every week. Tentatively, I would say, I think I'm just going to repeat what I said. Like, I don't want to be bullish or bearish because I've kind of have been bearish and called it wrong. So I don't feel like saying bullish is the right thing because you're kind of buying a high, and that's likely if the liquidity goes that way to absorb at the highs. That's what the current longs, want, and ultimately that will then trigger a sell back down. Or, is this a long-term thing and we need to keep rising until the stock situation sorts out? And we are in Q4, we get gas oil demand again. In Q3 is actually when you're not meant to get it.
Yeah.
I don't know. What's your thoughts?
Well, yeah, I'm kind of sticking with what I said last week, which was because of where we are in the year, we're starting to go into winter, and you've got these kind of low stocks in the winter, coming into winter. It feels like it's setting up for a bullish market in the winter.
CTA bullish.
Yeah. And if this is happening in the summer, and it just doesn't really, I don't really see how the situation would change much coming into winter when you have the real peak demand. Then you might have a demand driven story as well as a supply driven story. So yeah, I know it's like annoying to sort of change such a long term view, but I do feel like
that's
now, like I said, reluctantly sort of.
Yeah, I think the thing that's interesting is
hold my hands up and say it's
yeah, that's fine. But remember, we were talking a lot about utilization.
Yeah,
refinery utilization. So we thought refinery margins being as strong as they were, refinery utilization going up in the US, we'll get more distillates. I guess it's just not been geared that way. So OPEC are bringing more oil back online. That is producing more distillate. There are more distillate yielding crudes. But having said that, this refinery utilization story in the UK, in Europe, is probably the issue. And again, if we're going to add a sanction story and add freight costs essentially to the diesel price now, then effectively it has to go higher.
It's kind of supportive anyway.
It is very supportive.
Yeah.
And I think, as again, China not caring about it, not ramping up utilization. Is there enough utilization? A product trader said this not long ago in Onyx. It was like, the market's trading like it doesn't have enough refinery capacity. And it does, but it's not utilizing that capacity. I think that's what the answer is. It's China not utilizing it, and maybe others. So yeah, they're just ignoring the profitability and whatever, so it can stay where it is.
I was reading this, and another reason why China might be buying all of this oil is because the gold to oil ratio, I think, is currently at its lowest since the 1930s, except for
because they bought all the gold.
Yeah, except for during COVID, I think. So they could also be buying oil as a store of value right now. A lot of non-OECD countries are
that's
doing
fine.
that.
But again, they're not. We're talking about the refined products, right? Yeah. So yeah, no, fair enough. So we're bullish that.
Yeah.
I think I'll coattail you then. And then Brent, again, I would have been bullish last week. I don't see how, the front Brent spread just sold off incredible amounts yesterday. 30, 40 cents from 110 to 70. You always have to remind yourself in a backwardated market, there is actually not that much difference between 110 and 70 in the sense that from a physical perspective, that's still a very strong backwardation. It's still incentivizing you not to store. So there's not too much of a difference. It's a premium negotiation at that point.
Yeah.
So I just think that's an open interest thing. I still think it's very bullish. The margin's still very bullish. If you can run a refinery, you're running at max.
Yeah.
We think.
Yeah. We're going to die on that hill.
So, at least for the North Sea buyers, why would they not be buying oil? Why would there not be, places to take your oil? I don't see how you can take the other side of that right now.
Yeah.
So I think you kind of have to be bullish the whole complex.
Yeah. Well, I think last week we were kind of bullish all four, and I haven't really seen a reason to change that. So.
All right. A little air of defeatism in there, boy.
So just on the technical side, I am bullish gas oil cracks as well. And if you can see over here, we see it's pretty interesting how if you see that pink line and that lower pane over there, that just shows strength. So you can see that positive trend that we're seeing right now is strengthening quite a bit, which you could talk about overbought territory and everything, but the momentum is there to be long right now. In terms of Brent, I will agree with what you're saying, and it's really interesting. So even if you ignore the negative momentum in that second pane over there, the first pane, so that pretty cloud over there is a Japanese way to show. So it's a very, very popular way of analyzing the market. It's called Ichimoku clouds. But what they essentially show is sort of like a moving average. This over here is meant to be a really important point of support for the contract. And we have been seeing, it's very interesting that we tried to get out of it, but then stopped. And I think, I think we could see more support here.
Okay. All right. Thank you. And listeners out there, thank you very much again. This is another reminder that the Flux News Show in its current format will be ending, sadly. So this is now going to a research-focused podcast that will be available on flux.live and eventually only available on the Flux platform. It was a very affordable cost, $400 a month. We priced it that way because we think most people, most traders can afford that, and the information that's on there is worth an incredible amount more if you benchmark this against, people who are selling huge subscriptions out there. So you get it all free if you sign up. Please do that. We will be moving 100% that way. Got salaries to pay. These guys are expensive. So just a reminder on that. But again, thanks as always for listening, and see you again at least for 1 or 2 weeks. Thanks.